Assalamu alaikum everyone. I hope all of you are fine and doing great. I'm recording this video to discuss with you some exercises regarding chapter number 9 of managerial accounting. The topic is responsibility accounting. So in this chapter, in these exercises specifically, our point of focus will be on measuring the performance of different business units or different business centers and deciding which one is doing best as compared to others. So this is the first exercise which I have chosen for you, that is exercise number 9-7. And let's see what is the requirement for this exercise. So an investment center of Tribun Corporation shows an operating income of $7,500 on total operating assets of $125,000. So this is the amount of the assets the company has used in order to generate the operating income of $7,500. The requirement is compute the return on investment, and they want us to round off the computation to the 2 decimal points. If we have decimal points, we need to round them off. So if you see over here, the formula to calculate the return on investment is the investment is in operating assets, and this operating income measures the return on the operating assets. So when we divide the operating income with the operating assets, we get 0.06, and then multiplying our answer with 100, we get 6%. So this was 0.06 multiplied by 100, so return on investment for this investment center is 6%. So it means by utilizing the assets of $125,000, the company has generated a return of 6%. Moving on towards the next exercise, Eastman Company calculated its return on investment as 10%. So they already calculated their ROI, that is 10%. Sales are now $300,000, and the amount of total operating assets is $320,000. Now the requirements are, if expenses are reduced by $28,000 and sales remains unchanged, what return on investment will result? Now in the question, they already told us the current return on investment, which is 10%, and how would they have calculated it? Operating income divided by operating assets. Operating assets are already given, they are 320,000, but operating income is not mentioned. Okay, instead of operating income we have sales given. We all know from our previous knowledge of financial accounting that operating income is equal to sales minus expenses, right? Operating expenses. So let's try to figure this out. They say that if expenses are reduced by 28,000, logically speaking, when expenses decreases, they increase your operating income with the same ratio, right? So if expenses are going to decrease with 28,000, operating income should increase with 28,000, but we don't know what is operating income for the current ROI. So let's calculate our operating income first. So we know the formula for ROI, operating income divided by operating assets. Operating income is not known, but operating assets are given as 320,000, and we also know the current ROI, that is 10%. If you want to calculate operating income, take this operating assets to the other side of equation. Here it is in division form, the other side of equation it will become multiplication. So operating income is equal to operating assets multiplied by ROI, and when you do that, you get your operating income 32,000. Now you have two ways. One is the straightforward, as I already said, that if your operating expenses are going to decrease by 28,000, your operating income should increase with 28,000. The current operating income we have calculated as 32,000. So 32,000 plus 28,000, it's going to be This is 28,000 because expenses are decreasing with 28,000, so operating income is going to increase with 28,000. That comes up 60,000. But there is another way. Another way is, let's calculate our expenses first. Once we get our expenses, let's reduce them with 28,000 and then see the effects. So if I want to calculate my updated operating income, firstly I need to decide what are my expenses. So operating income is equal to sales minus expenses. We know the figure of sales, that is 300,000. We also know now our current operating income, that is 32,000. Okay, so when I do that, my expenses becomes 268,000. Now I get my expenses, let's reduce them and then find out what is our new operating income. So if expenses are reduced by 28,000, it will become, this is 268,000 minus 28,000. So updated operating expenses are going to be 240,000. So what will be my operating income then? Sales is 300,000, expenses are 240,000, so updated operating income is 60,000. This is what I told you just few minutes back, that we can also do the straightforward updated operating income without getting into these details. Okay, but if you don't want to do it directly, you can do it with more details, like first calculate the expenses, reduce your expenses, and then calculate your updated operating income. Okay, so they say that what is the return of investment if your operating expenses decreases with 28,000? Now since we have our updated operating income, so we can calculate our updated return on investment. So let's do that. ROI is equal to operating income divided by operating assets. Operating updated income we just calculated, that is 60,000, divided by 320,000, which are our operating assets. So this is operating assets, this is operating income, and I get whatever answer I get multiplied with 100 to get the percentage. So it is 18.75. It means that if our operating expenses decrease it with 28,000, our ROI is going to increase from 10% to 18.75%. Okay, moving on towards, if both sales and expenses cannot be changed, it means that sales will be 300,000, expenses will be not this one, the original you calculated as 268,000. They say if they don't change, then what change we should have in operating assets to get our required results of 18.75%, which we get in part A. Okay, so if I want to do that, let's firstly find out through the equation form. So I'm taking you towards that calculation. So let's do this. Formula is operating income divided by operating assets is equal to ROI. We want ROI of 18.75%. Operating income we already calculated, that is 32,000, divided by operating assets. Now we need to find out what change in operating assets. So I need to simplify this equation. Operating assets I'll take to the other side of equation, and when I take it to other side of equation, it will become in multiplication form, right? It will be gone from here, and now here this 18.75 is in multiplication form. I'll take it to the other side of equation, it will become division form. So 32,000 divided by 18.75. So when I do that, it's a rounded figure, $172,677. So it means that operating assets must decrease. Why I'm saying decrease? Because the original operating assets were 320,000. Now if we decrease them from 320,000 to 170,677, we will be able to earn a return on investment of 18.75% without changing our sales, without changing our expenses. So this is how we are going to solve this question. Moving on towards another measurement for the performance, or you can say responsibility accounting, that is known as residual income. Residual income means remaining income. Now what does it mean? It means remaining operating income. Why I'm using the word remaining? Remaining means, let's suppose if your organization wants to earn an operating income of 10,000, but your actual operating income is 15,000. So this is your required return and this is your actual return. So the difference between them is residual income. So this is how we're going to do that. In my example, it's 5,000. So let's read out this question. Climax Corporation has a desired rate of return of 7.5%. So it means that whatever operating assets they have, they want to earn a return of 7.5%. They want to earn, this is their required. So whatever 7.5% will be, that is their required return on investment. William Tobin is in charge of one of the Climax 3 investment centers. His center controlled operating assets of $4 million. So these are the assets they have, and they want to earn a return of 7.5% that were used to earn an operating income, earn 480,000 of operating income. So this what they want to earn, and the actual earning is 480,000. So now let's compare what is actual earning with what they want to earn. I don't know this figure, I will be calculating it, and then I will see, do I have a residual income or I have a shortage. So the formula for residual income is operating income minus required operating income, or you can say desired operating income. So how do we calculate that? Desired return, operating assets multiplied by desired rate of return, which is 7.5%, and the operating assets are 4 million. So when I multiply them, I get my required operating income, and then when I minus it from my actual operating income, I get my residual operating income. So let's check what is my required operating income. So when I simplify this expression, my required operating income is 300,000 and 480,000 was real operating income. So how much extra, how much residual we get? Residual income is 180,000. So let's move on towards the next question. Glitchenkopf Group operates two divisions. The following information pertains to each division for 2017, Division A and Division B. Now here we are going to do the performance evaluation of two divisions, that who has performed, which division has performed better. So Division A has the sales of 480,000, their operating income was 32,000, and the average operating assets which they were using, they were 200,000, and the desired rate of return, desired, this is not the real, okay, desired rate of return by the company was 10%. Of course, if they require 10% from Division A, they require 10% from Division B as well. Anyways, Division B has 300,000 of sales, operating income of 24,000, and the average operating assets of 160,000. The requirements are compute each division's residual income and then comment which division increased the company's profitability more. Of course, the one who earned more, it has increased the profitability more. So what we will be doing, we will be calculating the residual income for both divisions, and then we will be comparing the residual income of both divisions. The one who gave us more residual income, it has performed better. So the facts and figures are in front of us. So Division A residual income is equal to its operating income, it was 32,000 minus required rate of return was 10%, and the operating assets they were using 200,000. So this will be 20,000. So 32,000 minus 20,000 is 12,000. Then a residual income of Division B, their operating income is 24,000, but the required income was operating assets 160,000 multiplied by 10%, that was 16,000. So their residual income is 8,000. So if you see, Division A has given us more residual income as compared to Division B. So Division A has increased the profitability more than the Division B. In exercise number 9-11, we have some missing facts and figures, and we will be using different formulas to find out or to fill this information. So this is the Unify company, and we have there some facts and figures missing, and we need to complete them. So sales are 605,000. ROI is not known. Let's write the formula for ROI. We have two formulas. If you remember the discussion of this chapter, the ROI is equal to operating income. Sorry, ROI is equal to, yes, operating income divided by operating assets. And we have another formula for ROI, that is operating profit margin multiplied by turnover, sales turnover. Its details are given in the chapter discussion. Okay, so this is the formula for ROI. Two formulas are there. Operating assets, we will be figuring them out. Operating income, also from any formula we can calculate. We have turnover. So it seems that I can calculate ROI with the help of this turnover formula, because I have turnover with me. Residual income is also not given. Operating profit margin, this one, can you see, it's also given 0.08. So I can of course use this formula to calculate the ROI, and the desired rate of return is 10%. So let's start calculating the missing figures. Firstly, we will be calculating ROI. The formula to calculate the ROI is operating profit margin multiplied by turnover. So operating profit margin is 0.08, turnover is 2.2. So when I simplify this, I get 0.176, and the percentage is 17.6%. Next is I need to calculate the operating assets. Investment in operating assets or operating assets, they both are the same thing. Now we know the formula for the turnover as well. What is the formula for turnover? Turnover is sales divided by operating assets. We know turnover, that is 2.2. We know sales, that is 605,000. The operating assets we can calculate, right? So take the operating assets to the other side of equation and divide 605,000 with 2.2. You get your operating assets as 275,000. Now since we know our two ways are there to calculate the operating income, we can take the help of ROI formula, this one, because we know ROI, we know operating assets. Now operating income is missing. We can use this formula. We can also use this operating profit margin formula. Operating profit margin is equal to operating income, I wrote this formula over here, operating income divided by sales. Now operating profit margin is 0.08. Operating income we want to find out. Sales are 605,000. So when you simplify, that is 48,400. So operating income we also figured out. The last is residual income. Put the simple formula of residual income. So how can you do that? Your operating income minus desired operating income. How you calculate desired operating income? Operating assets multiplied by desired ROI, right? So let's do this over here. Operating income minus desired, this is the rate of return, multiplied by your operating assets. So you get your residual income as 20,900. So there are different ways to find out the missing facts and figures. You can use any of the formula. You can find out any of the missing fact first and then try to resolve the remaining facts and figures. Let's solve this exercise. This is exercise number 9-12, and we will be comparing return on investment with the residual income. The Monash division of Allgood Corporation has a current ROI of 12%. So this is their current recent ROI with recent operating assets and operating income. The company target, means desired ROI, was 8%. Monash division has an opportunity to invest 4,800,000 at 10%. Now this is the additional investment because it's an opportunity. They didn't do it yet, but they are deciding should we do it or not. $4,800,000 they can invest more at 10%. This is the return they will earn by investing this only 4,800,000, but is reluctant to do so because ROI will fall to 11%. Current ROI is 12%. The desired ROI is 8%, and if they do this additional investment, ROI will decrease from 12% to 11.25%. The present investment base for the division is 8 million, means the current investment base means current operating assets for the division is 8 million. So this ROI is based on this 8 million assets. Now they want us to demonstrate how Allgood can motivate to Monarch division to make the investment by using residual investment method. So they want us to use the residual investment formula and create the justification that this investment is good. So let's try to calculate the residual income in the current situation, and if we do this investment, then what will be the situation. So the current residual investment is your current operating assets multiplied by, because I need to the formula for the residual income is operating income, the current operating income minus desired operating income, right? And current operating income, how do we have it? It's simply your ROI, current ROI multiplied by your current operating assets. So current operating assets are 8 million and current ROI is 12%. So I get my operating income, and then after that I need to just calculate this, okay, minus my desired desired operating income. So how would I know? My desired rate was 8% and the assets were 8 million. So whatever answer you have, then you simplify this expression, you get your current residual income of 320,000. If they opt for this new opportunity, then what will happen? They will no more have 12% return. Their investment will, their ROI will fall to 11.25%. Now let's calculate ROI with the help of let's calculate residual income with the help of this 11.25 ROI. So the same formula, operating income, current operating income. So how do I calculate it? Now my assets, with this investment, my assets are no more going to be 8 million. They will increase because I'm investing more, 4,800,000, right? So my total assets will become 8 million plus 4,800,000, that will be 12,800,000 and multiplied by rate. So I just changed this operating assets to the new operating assets together. Okay, and also my return will decrease to 11.25%. After this, minus the desired one. So desired will be, of course, what will be updated operating assets. So operating assets are no longer 808 million, they are 12 million by adding this new investment, and the desired rate is 8%. When you simplify this expression, your residual income becomes 416,000. So it means that apparently it looks that your ROI will fall, but if you see the residual income, it is going to increase from 320,000 to 416,000. So because the new residual income is greater than the current residual income, Monarch division will be better off taking the opportunity. Okay, this is how we are going to justify. Next one is exercise number 9-13. Lumberton Home Maintenance Company, this is the abbreviation LHMC, earned operating income of $6 million on operating assets of $62,500,000. So these are operating assets, and this is their operating income in 2018. This is Lumberton Home Maintenance Company. Okay, the tree cutting division earned $1 million on operating assets of 10 million. So 10 million were their operating assets and 1 million was their operating income. LHMC has offered the tree cutting division $1,250,000 of additional operating assets. So they say that cutting division will be doing more additional investment of $1,250,000. The manager of tree cutting division believed that he could use the additional assets, means these additional assets he could use to generate operating income amounting to 112,500. So if they have this much additional assets, they can earn this additional operating income. LHMC has a desired return on investment of 8%. So this is their desired return. So many information is given. The current home maintenance company information is given, the tree cutting division information is given, and the additional investment information is also given. They want us to calculate the return on investment, ROI, for LHMC, means the main company, the tree cutting division, and the additional investment opportunity. So for all of the options, we have operating income and operating assets. So let's start with LHMC. So it's over here. LHMC has operating income of 6 million and operating assets of 62 million and 500,000. When you simplify this, your return on investment for LHMC becomes 9.6%. Tree cutting division has an operating income of 1 million and operating assets of 10 million, and when you simplify this, 10% is their ROI. Additional investment opportunity for the tree cutting division was 112,500 operating income they will earn, and the investment is 1,250,000. Right? Can you see the last line of the question, that with this additional investment they could earn an operating income of 112,500. So this information I'm taking over here. So this new investment opportunity will bring a return of 9%. Second one is calculate the residual income for LHMC, tree cutting division, and the additional investment opportunity. Now we have the desired as well, desired rate of return as well. So let's use the formula. What is the formula? Your operating income minus desired operating income. How do you calculate desired operating income? Operating assets multiplied by desired rate of return, right? So let's do this. LHMC has operating income of 6 million and their operating assets were 62,500,000. Desired rate of return is 8%. When you simplify this expression, their residual income is 1 million. Tree cutting division has operating income of 1 million, operating assets of 10 million. 8% is desired rate of return for all of them, right? So when you simplify this, 2 million is their residual income. Additional investment opportunity will bring operating income of 112,500. Operating assets means the investment is 1,250,000. Desired rate of return is 8%. When you simplify this residual income will be 12,500. So this is it about the discussion of responsibility accounting exercises. Our main focus was on calculating ROI, which is return on investment, through different formulas, and also residual income. We also try to figure out that if some information is missing, how can we find out that information with the given data. Please practice well. If you have any questions, you can write in the comment section or you can email me. I'll be trying to answer you on time. Take care everyone. Have a great day.